Okay, this is Business 436, your professor. This is May 22nd on Sunday. Your professor just sent you an email with what's coming up in the next three classes, and he sent a couple articles. And so I'm just going to go over these articles really quickly. The first one is startups, once showered with cash, now have to work for it. And as it sounds, they're just talking about how these, especially tech startups, 3, 4 years ago, they used to try to raise money, and it was just super easy. I mean, guys would beg to give them money, venture capitalists and that, and the terms were easier for the startups, and it was just a much easier environment. Now it has changed around, so that was gone from a seller's market where a guy's selling ownership in his company, right, to a buyer's market where the buyers, the venture capitalists, and the guys that are supplying the funds now are pickier about the what terms they get, the valuations. They ask a lot more questions. It's a lot more thorough process. It's just talking about how there's one company, basically this guy Hitchcock 4 years ago got $38 million, no problem. Then for his company Din, and then just recently he went for some more financing, and he basically had to give up being CEO, and it was tougher to get the money. And so 4 years makes a big difference in his case. So it used to be that the investors used to let the founders write their own terms. Now the terms are much tougher. They're basically, this one guy says it's like they're getting put through a proctology exam. So it's just a lot harder. The funding has gone down in the last year, 11% drop in funding for startups. So it's just a much tougher environment. In some cases, companies that have been funded in one round, the next round, their valuation is that the venture capitalists are valuing their companies, their valuation lower. And it's important to know that is called a down round of financing, right? Their valuation has gone down from a previous round to the current round. You don't want to see that happening. You want your valuation to keep going up. But if it goes down, that's considered a down round. Not good. Not the end of the world, but not good. Could just mean it was overvalued initially when people were giving away money, and now that they're paying more attention to what really it's worth. They realize that it was valued too high before, and it either stays flat or is a down round. It says about 20% of the valuations are either flat or down rounds this year. And it just says this is something known in the industry parlance as a down round. Okay. So anyway, that's what this article talks about. It's gone from a seller's market, selling equity in their companies to get financing, to a buyer's market, the people that provide the financing, they're the buyers, right? Because they're buying into the companies. And some of these startups are even looking to non-traditional lenders like Swedish investment firms. So, and it says at the bottom here, now he has been amused to hear that investors are struggling for smaller rounds. They're also cutting down the amount per round that they're funding. Less funding and a focus on not losing money. It used to be that investors just gave them money, didn't care if they were losing money. Now they want these companies to be making money. It says everyone told us we were wrong last year, that we needed to spend. Mr. Yoshimura said, now when you say you're profitable, everybody wants to invest. So now they're looking for profitable companies too. So it's just a much tougher environment for getting venture capital. This other article is about Twitter. Twitter says it won't reprice stock options to keep employees, but Jack Dorsey still wants to give them $100 million of his share. Basically, remember, stock options, you give employees a stock option saying, okay, you can buy so many shares of our stock at a certain price up until this point in time. Well, that's fine, except in the case of a company like Twitter, whose stock has been diving, they give those people the options, so it's an incentive for them to stay and to work hard to make the company profitable. So the stock price goes up, you can buy the stock options, usually for less you're hoping that your stock options are at a price that is lower than what the stock ends up going to. So you had stock options at 20 and you want the price to go up to 30, so you can buy those stock shares at 20 and then turn around and sell them at 30 and make $10 a share, right? That's basically what stock options are for. They're an incentive type of program. But in the case of Twitter, a lot of these people have stock options at 30 and now it's at $14.40 a share. So what are these stock options worth? Absolutely nothing, right? Because you can exercise, you can buy the shares at 30. Well, why would you do that when they're 14.40? So what some companies are trying to do is reprice their stock options to lower them, so to keep the employees incentivized. So in the case of Twitter, you might say, okay, we'll lower the stock options to $14.40 or $12 or something like that. But Twitter says they're not going to do that because that affects the stock price. Then you're allowing people to buy shares for less than the stock is worth, which that means more shares will be on the market, which will lower the price, right? Because if you've got a certain value, say you've got $100 million valuation and you've got 1 million shares out there, now you've got stock options for another 1 million shares that people buy those stock options, so now you got 2 million shares, but your company's still worth 100 million, but you've got twice as many shares, so the stock price will get cut in half. So shareholders do not like stock options being exercised. That's why you have to consider option pools when you value a company. That's what in those capitalization tables, because you got to take into account people can buy those, so you got to figure those basically as shares of stock, although they're not available at that point. You still got to price the company price per share based on those options because they could be purchased. So it's dilution. So if people exercise their stock options, it dilutes the stock, which lowers the price because the valuation hasn't changed. Just the number of shares available to shareholders have changed. Okay, and then they talk about the company who's been handing out more restricted stock units. I'll have to do more research into what they mean by restricted stock. Okay, so those are the two articles.